Okay, hello, Assalamu alaikum students. This is your teacher Azka, and I teach accounting and business to O levels, A levels, IGCSE, GCSE, and Edexcel students. Okay, so today I have a paper. Okay, um, okay, so this is the paper for Edexcel GCSE. As you can see, this is Pearson Edexcel International GCSE paper, and this is fresh paper, October November 2023. Paper 2. So in previous video, like I think few weeks back, I uploaded one video, and in that video I've solved paper 1, and in this particular video we are going to solve the paper 2, which is about the financial statements. So this is very easy, and we basically have this paper. The total mark of this paper is 50, as you can see. So I think now we should move forward to solve this paper. Okay, so as you can see that in first question, we have to prepare the manufacturing account. So first of all, just recall the basic format of manufacturing account so that you can solve this paper easily, because in Edexcel, if you see, your paper are not so much difficult, that it is not kind of very difficult, and it is making impossible for students. It will not make impossible for students to solve this paper. This is very easy. Okay, so Yola, a manufacturer, provide the following information for the year ended 31st March 2023. Okay, so we have this information. uh, we have the opening year, the year start and year ends balance of raw material, inventory of raw material, work in progress, and finished goods. Okay. And after that, we have carriage inwards, carriage outwards, and electricity bills, factory rent paid. This is also uh, the overhead expense for factory. We have insurance, we have other payables, and in other payables, there are some other. The other payables are factory supervisor salary, which is 350. Other receivables, which is factory rent, this is are basically advance expense, sorry, prepaid expense. So this is a prepaid expense, which is factory rent, which is 12,400. And um, we have the depreciation for the production machinery, and as you can see, the cost of the production machinery is 2,65,500, and provision, and its provision for depreciation is 81,000. It means this is its accumulated depreciation. It is showing us that these machineries basically depreciated till now with $81,000. Okay, so we have the purchases of raw material, which is 186,500. We have revenue, we have royalties. So we know that royalties kind of prime cost. And we have wages paid to production department, labor, factory supervisor, and administration. Okay, so we have first of all the condition. We have first information related to the depreciation. So production machinery is depreciated at 20% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase. Okay, so first of all, I think we should, find out the depreciation. So since this business is using the reducing balance method, so it means that for this particular year, for this 2023, 31st March, we have to find out the depreciation for this year only. So if you want to find it out, so this is very easy. What we have to do is, first of all, we have to find out the net book value. So for finding out the net book value, we have to deduct the accumulated depreciation. It means a provision for depreciation from the cost. So the cost for the production machinery is 206,500, and its provision is 81,000. So 206,500 minus 81,000. Okay, so 206,500 is, let me check, 0,6,500 minus 81,000. Okay, so we have the net book value, which is, so this will be showing you the net book value. So net book value is 125,500. So now we have to apply this 20% on this. So 20%, this is the net book value. So 125,500 multiply 20% divided by 100. Okay, so our depreciation is 251,000. So this is our depreciation for this year. Okay, and electricity and insurance are apportioned 70% of the factory and 30% to the administration. So it means that, as you can see, this factory rent paid, not sorry, not factory rent paid, sorry. Uh, okay, so this is $50,000 for electricity, and in for insurance this is 8,000. So we have to multiply $50,000 with 70% and $8,000 with the 70%. So we will get the electricity expense for the factory. 15,000 multiply 70% divided by 100. So we have 10,500. So we will be showing this one as the factory electricity expense. Okay, and 8,000 multiply 70 divided by 100. So we have 5,600. So this will be the insurance expense. Okay, so now let's move forward. Okay, so for making the manufacturing count, first of all, we have to write the cost of raw material. Okay, so first of all, I've written the raw material. So the opening inventory, which I am going to write here, that opening inventory should be in the form of raw material. So as you can see, this is 12980. You can just go upward. Yes, so this is our opening. This is our opening inventory for 1st April 2012. This is our opening inventory of raw material, which is 12980, and its closing inventory is 19170. Okay. So opening inventory and purchases. So if you see, the purchases for the raw materials were, so this is the purchase for raw material, which is 186,500. So this is the purchases. So for finding out the raw material cost, we have to add the opening inventory with the purchases, and we also have to add the carriage inwards, because this would also the part of the raw material cost, and this is 1610, and deduct the closing inventory of raw material from it. So you will see that you will be having the figure, which is 181,920, which is the cost of raw material consumed. Okay, and after that we have to find out the prime cost. So basically the cost of raw material consumed is also the part of prime cost. So prime cost is the cost which you can attribute easily, and it is mainly used to make the product, and you can trace it easily, the prime cost. Okay, so raw material consumed, the cost of raw material consumed, you will get, you basically got this answer. Now we have to find out the prime cost. So there are some other prime cost. If you see, like, there are the royalties, and royalties are also the part of the direct expenses, which is $12,000, and there are some direct wages which you give to your labors. So the wages you're given to your labors would also be the part of direct wages, because sorry, the part of the prime cost, because you can easily traceable, you can easily trace the cost which you basically invested to make the output. Because for example, if you have paid $100 to your labor to make the product, and let's suppose if you make $10 number of units, so you can easily find out the per unit labor cost by dividing the 100 by 10 number of units. So if you just divide 100 by 10, so you will get $10. So it means that if I just give the wages to my labor, so my labor cost is $10 per unit. So as you can see that you can easily find out, um, because this is a variable cost, you can say, you can easily trace it. But for example, if you are paying the factory rent, so factory rent would be 10,000 whether you are producing or not, whether your output is increasing or not. Basically, your factory rent would be the same. So that's why that would not be the prime cost. So prime cost, for the prime cost, there are different things we have to write which should be related to the production department. So this is direct wages, which is 95,600, and altogether you have to add uh, the figure of cost of raw material, which is this, with the direct expenses and with the direct wages. So we have the prime cost, which is 2,89,520. Okay, and after that we have to provide the overheads. Okay, so this is the electricity cost which we already found, and insurance cost we already found, and the rent paid for factory, which is 57400, and we also paid some wages to the supervisors. So this would be your overhead, because you cannot trace its cost because supervisor is not producing anything, it is giving you the services. And the representative we already find it, this is 25,100. So we have this expenses, the overheads basically, and this is our total overheads, 42,5870. The total overheads plus this prime cost. uh, okay, so now we have to add the opening inventory of work in progress and deducting the closing inventory of work in progress. So if you see, you will find it here. So in work in progress you have the opening inventory, which is this, and this is the closing inventory. So this is basically the format of manufacturing account. If you don't know, so you can just text me, and if you want me to make you understand then how to make the format of manufacturing, and if you just want the logical reasoning and explanation, so you can text me. I can guide you properly. So opening inventory is this, and the closing inventory is this. So you will be fine adding this one into this one, and all together you will be having the production cost. It means that for factory we incurred $4,27,040 to produce the output. Now we have to prepare the income statement. So income statement is not for the factory, it is for the office. So if you see that we have the revenue, so we cannot write this revenue in the manufacturing account because factory is not selling something. Basically, they are producing the output, and that's why we are concerned to find out its total cost of production, that how much cost we have incurred, whether this is overhead, whether these are the cost of raw material, whether these are the prime cost, like we know that the raw material consumed amount is also the part of prime cost. So whether this is prime cost or overheads, this is totally showing us the total cost, the total production cost which we put in basically the manufacturing sector in the factory. So but income statement is not for the factory, it is for the office or maybe for the outlet, for the shop where you are going to sell the produced output which you got from which you get from the factory. So first of all, we have the revenue, which is 8,27,500, and now we have to find out the cost of sales. So for cost of sales, we will be taking the opening inventory for the finished goods, okay, and we also need to add the production cost into it, because of course we need to find out the gross profit. So the production cost which you received from the manufacturing account, you also need to add it in the income statement, and after that you have to deduct the closing inventory of finished goods from these. So if you see that you have the total cost of sales, which is 4,09,340, and now you have to deduct this whole number from the revenue. So this is your gross profit. So now it's time to write the expenses. So if maybe you remember that carriage outwards are the part of carriage outward means that the carriage you basically spend to send goods to your customers. So that's why it the goods the goods which you send to your customers, you sent it from your outlet, not from the factory. So that's why this would be the part of income statement expenses, not the manufacturing account, not the factory cost. That's why. So carriage outwards, which is this electricity. Okay, so if you maybe know that we have the total amount for factory. Um, okay, so as you can see, yeah. So as you can see that electricity total cost, total expense was 15,000. But if you see this one, so here as we can see there is a condition, there is information that electricity insurance are proportion 70% to the factory and 30% to the administration. So we already calculated that what would be the 70% of each expense, 15,000 and 8,000. So 15,000 multiplied by 70%, so we have 10,500. So now just deduct this one from the 15,000. So you will get the 30%. The rest of the amount would be representing the 30% amount which you should apportion to the office. It means that you have to write it in the expense in income statement. Similarly, you have to deduct this 5,600, which is showing us the 70% of 8,000, which was a part of factory manufacturing account. So now the remaining amount means that 8,000 minus 5,600. So the remaining amount would be the part of income statement. So this is 4,500 and 2,400. Okay, so if you see that wages. Okay, so if you see that wages paid to the production and factory supervisors, and we already deduct it, or we already recorded it in the manufacturing account. But if you see that there are some wages which we pay to the administration, so all types of expenses which is related to administration, we have to record it in the expenses of income statement, not in the manufacturing account. So that's why these wages we have to record in the expense in income statement, which is 21,500. Okay, so this is okay. So these are my expenses with 30,790, and I have to deducted from the gross profit, which is 4,18,160. So I have the profit for the year, which is 3,87,370. Okay, so now we have the other question. On 1st April 2022, YOLA's current working capital ratio is 1.8 into 1. So current ratio or working capital ratio means that how much assets you have for the liabilities. So 1.8 into 1 is showing us that you have $1.8 of assets for each $1 of liability. So this is a good sign. Okay, so on 31st March 2023, ratio fallen from 1.1 into 1. Okay, so it means that their assets has been decreased against their liability. So previously they were having $1.8 of assets for $1 of liability, but now they have only $1.1 of assets for each $1 liability. So as you can see that maybe we are going to fall, and maybe in future we will not be having the proper and sufficient assets to meet with our debts. So evaluate the change in current working capital ratio over the year. So the current ratio has deteriorated, as you can see, which is actually deteriorated, indicating that YOLA may find it difficult to meet the short-term debts as they become due. Yeah. So in future they will be uh, bankrupt or something like that, or maybe they will not be having the enough assets to pay their debts. Second question is that explain one way YOLA can improve her working capital position. So YOLA may invest additional capital which will result in current asset increasing with no effect on current liability. Yes. If maybe they will invest some additional capital, if maybe they invest some more money into the business, so in that case they can increase their current assets without increasing their current liability. Because if maybe they will be taking bank overdraft or maybe loan, so if maybe they will be taking bank overdraft, so it means that they are increasing their current liability. So it means that their assets are increasing, but with that their current liability is also increasing. So they will no use. That's why if maybe they will invest some fresh capital, some new money to the business, new blood in the business. So in that case, again, we can say that because the current liability is not increasing, but instead their assets are increasing. So in that case, they can pay their liability in future very easily. But for now, this seems to be impossible for the Yola. Okay. So now let's see the second question. ED is a sole trader provided the following information. Okay. So we have this information. We have this balance at 1st May 2022. We have the fixture and fittings. We have the cost and the provision. We have bank, inventory, other payables, trade receivables, and trade payables. Okay. So we have to find out the equity. Okay. So for finding out the equity, so this is very simple. Okay. Okay, so for finding out the total equity, first of all, we have to find out the total assets and total liabilities. Okay, so this is now very easy. So we have the fixture and fittings, and its cost is 123,500, and its provision for depreciation is 55,570. So now deduct this whole amount from the cost because we have to find out its net book value. So you will have 67925. Okay. And now we have bank. So add this into the net book value plus inventory plus trade receivable, and now you have the total assets. So you have total assets, and it will be 171,105. Okay, so as you can see that, yeah, so this is basically total assets. So now we have to find out the total liabilities. Okay. um so first of all, we have the other payables, which is 1400, and we have to add this in the trade payables, which is 25,100. So we have the total liability, which is 26500. So by deducting the total liabilities from the total assets, we have the equity, which is 1,44,605. Okay, so this is the total activity, total equity. Okay, so we have this balance balances. Okay, so first of all, I think we should just see the requirement. Okay, so we have to prepare the financial position, statement of financial position, SOFP, at 30 April 2023. Okay, so for making the SOFP, first of all, we have to write the assets. So in assets, we have the non-current assets first, okay, and we have the current assets. Okay, so as you can see, that in non-current assets we have only the fixture and fitting. So now deduct this provision for depreciation from the cost. So you will have your net book value. So 275 triple 0 minus 9682 825. Okay, so you have 178,175. So this is your net book value. Okay. So now write the net book value in the non-current assets. Okay. So after that, we have to write the current assets, in which we have the inventory. Okay, so we have the inventory, which is 17600, and we have the total receivable, and total receivables were 85,500. But if you see that there is an adjustment, so we have the trade receivable, which is 86,500. Okay, but if you see that there are adjustment, that profit for the year ended 30 April 2023. Okay, so this is not, yeah. So this is basically the allowance for irrecoverable debts, which is 2% of trade receivable. So it means that we have to multiply it with the 2%. So for finding out the allowance for trade receivable, so 86,500 multiply 2 divided by 100. So we have 1730 as the allowance of trade receivable. So that basically we cannot write the trade receivable altogether, because this is the allowance which we are basically 1710 is representing us that we have the allowance that may be from 85,500. This amount we will not get. So if we will not be getting this amount in the future, because maybe this will went bad, for example, in the future. So that's why we have to deduct this from the trade receivable, because this amount is not our current asset. So it will be decreasing the trade receivable. That's why we have to deduct it here. So 85,500 minus 1710. So we have this one 83,790. So we have this total assets, which is 279,565. So now we have to write the equity and liability. So in equity, if you see that we have invested some money in the business. So yes. Okay, we already find it. So this was the equity 144605. So we have to write it here in the form of equity. Okay, so we also have to write its profit. So and its drawing also. We have to deduct the drawings from the capital and add if we maybe made profit in the year in income statement. So we have to add it in the capital. But if maybe we made loss in the year, so we have to deduct it from the capital. But if you see that they are showing us the profit for the year ended 30 April 2023, which is 45,670 before. So these errors we made. It means that this is not the right profit. This is the draft profit. So this is our draft profit. It means that there's something which we still have to deduct from the this profit. So draft profit is equal to 45,670. Okay, so as you can see that we have some errors, written off and irrecoverable debts of 1,000. Okay, so basically we didn't write off these debts 1,000. So now it means that we have to deduct it now, and it will be decreasing our profit. So deduct 1,000. Okay, creating a provision for irrecoverable debts of 2% of trade receivable. So we know that we also have to deduct this from, we have to write, basically these two things should be written in the expenses. So since we didn't record it, and that's why now we are deducting it from the draft profit. So as we can see that the 2% of the total receivables were 1730. 86 500 multiplied 2 divided by 100. Okay, so now we have to deduct it. So 45670 minus 1,000 minus 1730. Okay, so so this is the profit for the year 42960. So this is now the corrected figure for the profit. Okay, and if you see that there is one more adjustment for the drawings. During the year ended 30 April 2023, ED took cash of 6090 from his own. So this is the drawings. Everything which an owner take from the business for his own use, these type of things would be drawings, and drawings should be deducted from the capital. So that's why, as you can see, that I have deducted the drawings from the capital, which is 6090. So we have this total equity, which is 181,475. In the non-current liability, we have the bank loan, and in current liability, we have the trade payables, other payables, and bank overdraft. So you can also see it from here. So we have this bank loan. We have, if, as you can see that in front of the bank, they have written the CR. So CR means that we have overdrawn the bank. We have overdrawn the amount from our bank. So this is showing us the bank overdraft. So if maybe they would have written here this DR, debit balance, so it means that that would be our current asset. But if the CR written in front of this 2650, so it means that it's showing us a bank overdraft, and this is, would be our current liability. So that's why we have written it here as a current liability. Okay, so yeah, so now okay, so as you can see, now we have to add this total equity with the non, with the total of non-current liability and with the current liability. So we have this answer, which is 279,565, and if you just compare it with the assets, so this is also giving us the same answer. So it means that our both sides are similar. We just balance our statement of financial position, so it means that our question is right. Okay, so we have this last question. ED is considering investing in the computerized accounting package. Evaluate the disadvantages of this proposal. Okay, so we just need to evaluate its disadvantage. So if we just if ED is going to invest in a new computerized accounting package, so what would happen? So cost of the hardware and the software may require a fresh injection of capital. Yes, and if you see that we already have the negative current ratio, which is 1.1 into 1. So there is a risk that data may be lost or corrupted due to the computer virus. So this is the second disadvantage. So therefore, ED's business may not benefit from this investment. So in 5 mark question, writing one at disadvantage, you will be getting 2 marks, and writing the other disadvantage, you will be getting the other 2 marks, and writing at the end, the making conclusion at the end will be giving you 1 mark. So that's how you get the 5 marks for this question. And after that, we just completed a whole paper. So congratulations. Okay. So now I'm going to end this class. But if you have any question, so you can just comment under my comment section, and you can also um, basically, I'm just going to start my online sessions for OA levels accounting and business, IDCSE, GCSE, and Edexcel. So from 15th August, our classes are going to start from the 15th August. So that's why if you are also interested to take my classes, so you can just text me on WhatsApp, and we can talk about if you just want to have the other informations about my fee structure and about timings. So you can text me on WhatsApp, and I will be reaching out to you soon. Okay, so goodbye, take care, Allah Hafiz.